Acumen competency. 1. Business and competitive awareness. Business acumen is defined in the SHRM body of applied skills and knowledge as the KSA's knowledge, skills, and abilities needed to understand the organization's operations, functions and external environment, and to apply business tools and analyses that inform HR initiatives and operations consistent with the overall strategic direction of the organization. The business acumen competency allows HR professionals to apply knowledge of an organization's business model and competitive situation when solving workforce problems. It can be combined with other competencies, such as analytical aptitude, consultation, and communication, to deliver strategic support to HR's organization. Consider the following situation. Value creation. Value can be defined and measured differently. In a general sense, it refers to an organization's success in meeting its strategic goals. Values. Organizations' assets, financial, people, technological, and physical. Organizational values relate to guiding principles and beliefs. The definition of value can be influenced by an organization's mission, and the culture at an organizational, global, and workplace level. HR must understand these varying perceptions of value because they will drive strategic goals throughout the organization and affect the ways in which HR can support the organization in its entirety. Value chains. The value chain represents the process by which an organization creates the product or service it offers to the customer. This may also be referred to as the organization's business model, every activity required to make a good or service and then sell or deliver it. The process is described as a chain because it represents the sequential and simultaneous contributions of a number of internal and external participants. Each participant adds an element of value, and the total value is more than the sum of its parts. Key content. The key value that HR contributes to the value chain is the quality and availability of pivotal talent pools, those employees whose skills are critical to the organization's strategy. HR protects value when it manages labor supply to support optimal productivity. It enhances value through its leader and performance development processes. It can add value when it acquires strategically important new areas of talent. Organizational and product life cycles. Life cycle concept. Introduction. Revenue, the vertical axis, is low because there is little market awareness of the new industry organization, products, services, or processes, and because of the market's resistance to change. Entrants, new industries, organizations, or products must create an identity with customers and develop a value proposition. This takes imagination, business acumen, and leadership. Growth. As time proceeds, the horizontal axis revenue begins to increase. LHE rate of growth, or the steepness of the curve, will vary by industry, enterprise, or product. The focus shifts to creating processes that will increase efficiency without stifling innovation. Maturity. The market is saturated with competitors, and growth occurs only through introduction of new products or customer groups, which starts new cycles for those entrants, or through acquisitions. Profit margins become narrower, and efficiency becomes more important. This means greater formalization and perhaps bureaucracy. Renewal, no growth, decline. Eventually demand will decrease, either because the need no longer exists or it is satisfied more effectively by something or someone new. Organizations can innovate and renew themselves by completely changing their offerings, where they compete, or how they compete. If they succeed, revenues rise. Take no action and accept continued low revenue. As time goes on, organizations and products have few resources to take advantage of opportunities that might deliver growth. Take no action and experience a decline in revenue that will make it impossible to compete or operate. Macro-environmental forces influencing strategic decisions. The macro environment refers to all the factors that exist outside the organization that could influence an organization's strategic decisions. HR leaders are expected to be familiar with and informed on areas that affect the management of an organization's human capital. As a result, one of their responsibilities is to analyze the environment in which the organization and its employees operate. Conducting a PESEL analysis can help in acquiring information about the factors that might affect strategic decisions. A PESEL analysis looks at the following: political, governmental and other political forces that can exert influence on the economy or a specific industry, for example, new or changed taxes, employment laws, and trade tariffs, barriers, and restrictions. Economic, market and other economic conditions that can affect an organization, for example, interest and exchange rates, wages, cost of living, and working hours. Social, events and trends in society that can affect the present and future availability of talent, compliance requirements, and employee needs, for example, health and safety consciousness, population demographics, and growth rates. Technological, changes in technological capabilities and availability that can affect an organization's ability to produce and provide goods and services. These factors also include technological literacy levels and research. Legal, laws and regulations that can affect an organization's operations. Global organizations have to navigate different countries' legal systems in addition to those in their home country, which may require extra care. Environmental, geographic and climate changes that might affect an organization's operations, for example, extreme weather that may disrupt operations or transportation of goods for a specific area or an entire region. Improving environmental awareness. HR professionals can develop their awareness of their organization and the environment in which it operates by regularly reading the business press, staying current with the latest academic HR research, analyzing the organization's performance, monitoring the performance of other organizations, becoming regular users of third-party information from government agencies, scanning annual reports from businesses or with comparable markets and workforces. HR advocacy. HR professionals can keep track of current events and trends that affect the workplace by belonging to professional associations such as the Society for Human Resource Management. Members receive regular and special mailings and can meet peers from other organizations at chapter meetings. Useful business terminology. There are certain key business terms that all HR professionals should become familiar with. Supply and demand. Supply refers to the availability of the good or service. Demand refers to customers' desire to purchase goods and services. Strategic plan. Plan that defines an organization's purpose and direction and can provide guidance to HR on the organization's core values and objectives. Typically, a strategic plan contains the following components: vision and mission statements, core values, goals and objectives both long and short term, SWOT analysis, action plans, financial projections, an estimate of an organization's future financial performance. Typically, projections address a specific 12-month period, broken up monthly and by department and/or function. Projections are a valuable tool for translating goals into targets and serve as a feedback and control tool. Competitive advantage. The factors that enable an organization to outperform its rivals, that is, produce goods or services better and more cheaply. Factors can include but are not limited to branding, product quality, customer service, distribution network, intellectual property. Quality. A measure of comparison for products and services. For example, is the product or service offered by the organization of superior or inferior quality when compared to that offered or produced by rivals? Key performance indicators (KPIs). Specific measures of an organization's critical business areas that are quantifiable or qualitative. KPIs can vary depending on how, when, and where they are used. Revenue. The money generated through the sale of goods and services. Revenue is calculated by multiplying the average sales price by the number of units sold. It is also referred to as gross income. Net income. Revenues minus costs. This is also known as net earnings. The subtracted costs can include expenses, operating, administrative, and so on, taxes, interest, and depreciation. Profit and loss. A calculation based on total income minus total expenses. If the result is positive, revenue exceeds expenses, the organization has generated a profit. If the result is negative, expenses exceed revenue, then the organization has posted a loss. Fixed and variable costs. Fixed costs are recurring costs, regardless of an organization's output, for example, interest payments, lease, rent payments. Variable costs depend on the organization's output, for example, labor costs and costs for resources, materials. It is possible that an organization will have semi-variable costs, for example, volume discounts.